Lisa Shalett, Morgan Stanley Wealth Management Chief Investment Officer, joins us this morning to talk about the upcoming year. Lisa, great to have you. Welcome.
Welcome.
It does sound like you are looking for growth, but you do argue that there's a possibility growth slows before it reaccelerates.
Absolutely. Look, I think one of the things that folks aren't completely processing here is we've got a two-speed economy. We've got a portion of this economy among the mega caps and among, the wealthiest households who don't need rate cuts. But then we have smaller mid-cap companies. We have the bottom 60% of U.S. consumers who actually do need rate cuts. And so if we're moving into a period where, the economy is hotter, our best guess is inflation is also going to be hotter. We're not going to be able to get rate cuts, and consumers may quickly find themselves disappointed about the great promises about how inflation is going to continue to come down. And that becomes a source of mitigation on some of the animal spirits around spending.
So what do you make of this sort of across the street, this tight cluster of year-end targets for 25? Why is it so concentrated?
Because I think valuations are extraordinarily high, and it's just not prudent from a fiduciary perspective for strategists to be throwing out there that we're going to get a third year in a row of double-digit returns. This is an extraordinarily expensive market on profit expectations for next year, which I remind everyone, that's growth of 15% in earnings, which this S&P 500 has not done since 2021. So very high valuations on very high expectations. It's a tough formula here. And if we don't get rate cuts, those multiples are going to come in. And so I think it's prudent for strategists to be more measured, even if they're constructive and reasonably bullish like we are, to say this is going to be an average year. It's going to be a 5-7% grinding year where we're going to have to wade our way through the mosaic of headlines about policy, some of which are going to probably come out more like Swiss cheese than a blanket. And what I mean by that is you're going to have to pick and choose because there's going to be carve-outs on tariffs and which companies, which countries, which product categories are impacted. And so this is just going to be tough. And I think we're talking about a single-digit market at best next year.
Lisa, I feel like you've been cautious and sort of warning for a while now. I mean, nobody expected a 26.5% up year for the S&P 500, but where have you been most surprised at the positivity we've seen in this market and through earnings? Because I think you said last year at this time, the market was overestimating things.
Yes, we've been wrong. There's no doubt about it. And I think the fundamental place where we've been wrong has been the resilience of GDP growth. And fundamentally, I think we're in a very interesting period in history where, in fact, high interest rates were stimulative to those sectors of our economy, like those large mega cap companies, like the richest households who had excess cash and have been spending it. And so that's the piece of this has been GDP resilience at the high end that has kept this economy going. I don't know if we're going to be able to keep relying on that as the singular engine. I do believe we need to do the handoff and get some breadth in this market. But that's probably going to take lower interest rates, and we're not going to get them if we stay high. So we're in this kind of catch-22 here.